Hi everyone, welcome back to another episode of Timeline, where we look at the key developments in Sri Lanka for the past 7 days. A lot has happened since we last spoke. A key development has been we got a bit of clarity on the domestic debt restructuring program. The dollar rupee has fluctuated quite a bit, and also we have feeling the effects of the gradual slowdown in the global economy. With me in the studio is Shehan Cooray, Director, Head of Research at Acuity Stockbrokers. Hi Shehan.
Hi, and thank you for having me. Yeah.
So let's start with the most important or the latest development by the State Finance Minister just 2 days ago, Shehan, in terms of the initial framework for the debt restructuring process. I believe he mentioned that there might be a cut in the interest rate and there won't be any change to the principal amount of the outstanding debt. How are you seeing this play out?
So I think earlier this year we did a report which gave our projections and likely scenarios in a debt restructuring. So what we also said is that it's unlikely that they will go for a cut in the haircut on the face value of the debt. It will most likely be term extensions and cuts to the coupons. So I think that is what they have reiterated as well. So that's coming in line with the market's expectations. So there were no major surprises there. And also I think it's basically following through with what they have said, that it will be more or less a voluntary debt swap or debt exchange. So probably that would mean that it'll be mostly the treasury bonds, about half is with the EPF and NSB, and then the significant portion is also with the bank. So it'll, I guess, voluntary means that mostly the EPF and the NSB will be taking up, the government-owned entities will take up the bulk of the debt exchange, and the banks also will possibly be given incentives to voluntarily take up the debt exchange as well.
Okay, that's interesting. Just 2 points I wish to take up on what you mentioned. First, on the voluntary aspect of things. How is that going to work in terms of, if some people are going to accept a haircut and some people not necessarily a haircut, but kind of a restructure of their debt. Yeah. And some of the other domestic banks are not going to take up the restructuring. That's one thing. And my second question to you is, how is this going to be accepted or rejected when compared with the international sovereign bondholders, when they're seeing such leeway or such flexibility given to the domestic debt holders?
Well, there are 2 aspects. There are the EPF is different to, say, the commercial banks and so on, because they can afford to take term extensions and so on, because basically it's a long-term investment fund. So the net inflows to the EPF on a monthly basis is much more than the net outflows. So the bond maturities and the interest that they earn on their bond portfolio is on top of their net inflow. So it doesn't really matter to them very much whether the bonds that they hold get a term extension or not, because it doesn't affect their cash flows or anything like that, or it doesn't affect the ability of the EPF contributors when they want to when they're entitled to withdraw their funds and so on. So it's a bit different for the banks, because although banks can also afford to hold, but they would match their long-term liabilities, and they would match their assets and liabilities. So if the asset is being stretched to a more long-term asset, then that would create a mismatch in their asset on their balance sheet, and typically there would need to be provisioning done for those mismatches and things. So in terms of, it can be a present value loss. So it's important to realize that's not a realized loss. It's only it's an unrealized loss. It will only materialize into a realized loss if they try to sell those bonds and the they had to realize, and the market value of those bonds is less than what they're carrying on their books. But there'll be incentives that they're given to be able to take that up. One is like regulatory forbearance, where they can keep those bonds in the the bonds are in their held to maturity portfolio. So any unrealized losses, if there is normally any provisioning that would need to be made, they will be exempted from probably having to make those provisioning to avoid the impact on the capital. And the other is that the most important reason for doing the bond optimization is to bring down the yield curve and bring down the high interest rate structure. So when the interest rates come down, that unrealized loss automatically gets wiped out, because the market value of the bonds that you're holding, even the restructured bonds, will go up in price. So then there is no loss. So actually, it's possible that if, say, interest rates come down to about 10% or the sort of levels that they were before the crisis, that a lot of the banks will actually make a gain rather than a loss, even if they take up the voluntary bond exchange. So those are some of the incentives, and they'll be given other regulatory incentives as well, like the new bonds will most likely have higher liquidity. So the central bank, for liquidity purposes, if the bank wants to give the bond as collateral to get funding from the central bank, there'll be higher collateral value for those new bonds compared to the old bonds. So there are lots of carrot and sticks that they can use to encourage the banks to take up the bonds, including maybe on the restructured bonds, the coupons will be higher than what they will issue in the market post debt restructuring. So there are lots of other ways that they can incentivize the banks to take up a
Okay,
voluntary
interesting.
exchange.
And before you come on to the area where how international bondholders will feel about it, I just have a follow up on what you mentioned.
Yeah.
So, as a result of a commercial bank engaging in this restructuring process, there'll be a loss, there'll be a hit onto the capital base.
That's what's called a first day loss. It's
It's
just an unrealized loss. Because on the very first day after you do this, the interest rate, the yield curve won't go down.
Sure.
So you're discounting the new bond at the same yield as the market yield as was prevailing the previous day.
So will there be an issue where they'll have to pump in equity in terms of capital adequacy ratios will go for 6?
So that's why for one thing it's unrealized loss. So whether they even need to take that loss or not is debatable. So even if there is some sort of accounting regulation which requires them to realize an unrealized loss, they will be given regulatory forbearance, so that doesn't need to happen, because it's only an unrealized loss, and as the interest rates come down, that loss would reduce, so it may turn into
a gain as well. Yes, absolutely. I see your point.
Yeah.
So then, reading some of the articles around there seems to be a bit of hesitancy from the local commercial banks for this restructuring process. But listening to you, Shehan, if it's such quote unquote mild impact, why is there a bit of hesitancy?
So it's called game theory. So it's in the interests of the banks not to take up the voluntary exchange themselves, but to get other people to take it up, because when the interest rates go down, even the value of the existing bonds go up. So because you're discounting at a lower rate. So it's obviously in their interest that without taking any of the pain, they will want to get the benefit, and let the EPF or some of the other stronger capitalized banks take up the temporary pain, if anything, and they will the other bondholders will also gain from it. So that's mainly.
It almost sounds like it's purely self-interest, as opposed to making a gain almost. In the process of.
Obviously there'll be legitimate concerns. This hasn't happened in Sri Lanka before. So
Okay.
obviously there will be legitimate concerns with from the side of the banks whether things will pan out as expected, whether the interest rates will actually come down, whether a lot of countries that have gone through this kind of debt related stress have had to, if the exchange hasn't been done properly, they've had to go for a second debt exchange or debt default a few years down the line. So obviously, that's why they'll be hesitant, because they would want to be sure that, it's not something where they take some loss or potential loss now and then we have a bigger problem a few years down the line. So that's why, so the hesitance is understandable because, we haven't been through this situation before. But if everything goes to plan in the way that the central bank and the advisors would be expecting, then probably the impact on the banks would be negligible, or it may be a positive impact.
Okay, interesting. I see what you're saying. I watched this webinar where Dr. Indrajit Kumaraswamy was interviewed. He was on the panel for, again, talking about Sri Lanka for the Loki Institute. And he also mentioned that 60% of the time, countries that restructure their debt goes back to the IMF for a restructuring program in a few years down the line. So it's not just because you restructure now, there's always a danger that you'll have to kind of restructure a few years down the line, as you're mentioning.
Yes. So it's, the debt is part of it. So bringing the debt back into sustainability. The debt restructuring, haircuts, term extensions, that's one part of it. But then there's a whole program that needs to back it up as well in terms of the ongoing fiscal consolidation, in terms of the growth enabling reforms to the economy, the reforms of the state-owned enterprises or whatever, because they are the root causes that led to the debt problem in the first place, because if those are not addressed, then obviously you will have another debt problem down the line. And it can even be because we don't meet the growth targets that have been set, although I think in the IMF's base case scenario they've set fairly low thresholds in terms of the growth and things that they're expecting. So it's possible that we can surpass those targets, but obviously there can be risks and political external risks where we may not meet those targets, we may not be able to implement those reforms. So then there can be another debt problem down the line.
Sure. That's one area I'd like to talk a bit more detail later on. So coming to the second part, in terms of how the international sovereign bondholders, who I believe was it 7 billion or was it 13 billion they hold? Or?
The ISBs are about 13.6 billion.
For them looking at the current, what the government is doing with the domestic debt restructuring, how would they see it?
So I think, from the point of view of the ISB, there are multiple, facets to that. It would depend on how they see, what caused the debt default in the first place. Was it purely a loss of market access, or was it something more structural, how they see the recovery in the economy, whether they think that, the economy will recover faster than the IMF's base case projections, in which case the government's ability to repay that debt may improve faster than expected. So they wouldn't want to take unnecessary haircuts or term extensions if they think that the government will be in a position to service that debt faster than expected. But from what's happening with the local debt restructuring, I think it's understood that in any domestic debt restructuring, you would minimize haircuts and things like that, because that will create a lot of instability with the financial sector in the country, and that will definitely impact the growth and the ability to service the foreign debt. So no one is. I don't think it'll be in their interest to push for something that will cause greater difficulty and make it unlikely that they will get their money back either. So so I think it's a balancing act in balancing the interests of all. In terms of the other adjustments that have to be made, like the fiscal consolidation and all that, which are basically the exchange rate adjustment and fiscal so all those the painful parts have been done. So I think from the point of view of the international debt holders, they can see that the government and the local bondholders have taken a substantial hit in terms of because of the devaluation, the real value of their debt has that they're holding has come down, and inflation has wiped out the return on some of those bonds that were issued at say lower interest rates in the past. So the domestic debt holders have taken significant hits, even if they're not taking a face value cut, whereas the international bondholders, they are getting repaid in dollars, which haven't depreciated or whatever. So you have to balance out both those effects. Yeah.
Okay, sure. Right, that's interesting. So linking that to how the IMF funding facility is being rolled out at the moment, we got our first tranche, and the first review is going to come up in September. You would have seen Welter Research said 26 conditions have been met and we've fallen short of 3. That seems to me that we're making very good progress. What are your thoughts on the
so
first
I think
review?
Stick to the specific debt related targets, because obviously there are a lot of other targets in terms of reforms, new legislation, independent central banks, all that. So leaving that out, on the the debt side, the major targets that the government has to meet going forward, not just for the first review but for the next 4 or 5 years, is on the primary balance of the fiscal deficit and the gross financing needs part of the debt. So basically so the fiscal balance is a function of the revenues and the government's expenditure. So there is a process of revenue-led fiscal consolidation that started with the last budget, with the huge tax hikes and so on. So I think they've been successful in that, because as per the first quarter of this year, they have had a surplus in the primary balance of the government budget. So, and that's ahead of target. I think the IMF was only looking at a surplus in the primary balance in next year or year after. So they've made very good progress on the fiscal consolidation part. Whether that will continue throughout the rest of the year and next year, I can't comment on that. So the next part.
Shehan, just to be clear, when you say primary balance, what does that mean?
Yeah, so that's the government's budget deficit minus the interest costs. So basically, it's revenue minus all the expenditure except the interest expenditure, because the interest expenditure is obviously set by the market. And the interest cost is determined by the market rates.
Okay.
So in order for the debt to reduce as a percentage of GDP, you need to be generating a surplus in the primary balance. So assuming, say, your primary balance is 0, that means you're borrowing only to service your interest costs. So as long as the cost of that, as long as your interest cost is less than the rate of growth of nominal GDP, your debt to GDP will continue to come down over time. So if the larger the fiscal, larger the primary balance surplus, the faster that the debt metrics will improve, assuming that your interest costs and things are kept at manageable levels. Yeah.
Right. Do you have any clarity which areas will we fell short of?
In terms of the fiscal side, or
in terms of yes, the fiscal side.
Fiscal side, as I said, they're ahead of target, but
Okay.
I think on the revenue side, there's slightly short on like excise revenues and things like that because of lower imports, and also inflation is coming down. So the nominal growth in GDP's nominal numbers are less than what it was last year. So mainly because of that.
Okay.
So if at all, it's but generally it's on the revenue side, it's on the fiscal side, on more or less on target. So then what needs on the other debt targets they need to meet the gross financing needs targets and so on. So that is where the whole DDR and DDO comes into it, because in order to meet the IMF's targets of bringing the gross financing needs down to 13% of GDP and so on, it's wouldn't be possible to meet those targets without both the domestic debt restructuring and the foreign debt restructuring. So gross financing needs means both your budget deficit plus the rollover of the debt that is happening that year. So that's why when you push back you extend the term on the bonds and so on, there's fewer bonds that are coming up for maturity, so that reduces the pressure on the gross financing needs.
Right, interesting. Okay, so it's good to hear from you that we're doing good and primary surplus, we have achieved primary surplus and so on. How are you seeing the policy aspects? I read that the Central Bank Act has yet to be passed, and that was one of the conditions of the IMF to have an independent central bank. Yeah. Is that a key stumbling block in terms of it won't get passed, or are there any other policies like that is stuck at the moment?
So the political, since passing this legislation is partly a political process, I can't comment too much, but I think there wasn't any, at least the ruling party and the MPs that are backing the government and who have they managed to pass some of the legislation so far. I don't think they had any major objections to the Central Bank Act. I think there were some areas that had been highlighted by the Supreme Court and so on, which where some amendments had to be made. And I guess the main opposition parties also generally in favor of most of the proposed reforms that the IMF has proposed. So there may be short delays, but I don't expect there'll be any major hindrance to getting these things through. Yeah.
Interesting. Okay. One of the key questions that everybody's asking is what's going to happen to the dollar rupee? Where are we heading? From, I believe, 2 weeks ago, there have been significant fluctuations, and for the month of May were with the best performing currency in the world or something, or in Asia. Yeah. It's very difficult to get a view, and so if you're in the trading business, it'll be very tough to get your forward rates and do business. So two questions on that, Shehan. Firstly, what is causing these fluctuations that we're seeing now? And where do you think what range do you think it'll settle at come December?
Right. So I think at the end of last year, we said that there will be a small probably there will be an appreciation in the currency. So when it was at 360, 370 levels, maybe to at least to 350 levels. So when it went to like 290 or whatever, that was a bit unexpected. But I think so. What's driving the appreciation in the currency is that the current account of the balance of payments is presently in surplus. So that's because with the huge depreciation of the currency that we had and the economic contraction, imports have really come down, and also exports last year they were doing well, but I mean this year with the international global recessions and so on, exports have tapered off a bit, but imports have fallen much faster, and currently we are having very strong inflows from the other sectors like remittances, tourism, and so on. So that's why there's currently a surplus in the current account balance. So as the economy recovers and so on, then obviously imports will increase slightly, but we don't think there's going to be any major increase in imports, because if you take the imports in the average imports in say 2018-19 year and last year, the main reduction is about 1 billion rupees per year in vehicle imports, and about 1.5 billion I think in investment goods. So investment goods are like plant and machinery and things like that. So in terms of like consumer imports, intermediate imports, those are actually at the same level or higher than they were pre-crisis. So that's like fuel and imports that are used for exports and things like that. So in terms of investment goods imports, that's not going to recover immediately, because it's gone through a big crisis. Interest rates are still very high, so it'll take maybe 6 months, 1 year time lag even after interest rates come down to say a manageable level, like say borrowing rates come down to 12-15% before business people and so on start taking loans and start investing in factories and things like that, which will cause higher imports of investment goods. That's one, and also then the second part is the vehicle imports. So that 1 billion a year, 100 billion a month at its peak, so $100 million a month at its peak in the pre-crisis level. So I don't think they're immediately going to open up the vehicle imports. So and even if they do open it up, it can be done gradually, and there are plenty of countries like Singapore and whatever where they don't have unrestricted vehicle imports. It's there's like a quota system, and you have to bid for a permit, and so there are all kinds of ways that they can restrict vehicle imports to and keep it at a manageable level. So even with imports picking up, obviously remittances, tourism, those dollar inflows are also going to pick up, especially towards the end of this year. So I think by November, December, tourism is expected to hit back to its pre-COVID levels. So in November, December, it's possible that tourism and remittances alone will be generating about $1 billion a month in inflows during the peak season for tourism and so on until the early part of next year. So that's why we think this year the current account balance in the balance of payments will be coming in at the moment it's in a surplus, but we think that even at the end of the year it may be at zero or at a very small surplus. So that's why there's no major pressure on the currency. So we think that by the end of the year the currency may be at like 320, 330 sort of levels. And also the other factor is the real effective exchange rate. So currently with the huge depreciation, overshooting depreciation that we had last year, the real effective exchange rate is at a historically low level. So whenever the real effective exchange rate has been at these sorts of levels, there hasn't been huge pressure on the currency to depreciate, but that's during more normal times. So here we are grappling with the after effects of the economic crisis, and there's still we don't have market access to to borrow from the international markets and so on. So obviously there's going to be supply demand pressures on the currency which are not reflected by its fundamental value of the currency. So it's possible that there will be some pressure, but we think it will be manageable in the current year and next year.
Sure. Interesting. I mean, listening to you, it's a very positive scenario that getting from you. I mean, we've had troubles in the past and we turned it around, managing our fiscal issues to the domestic debt restructuring side, and then moving on to the currency per se. I mean, it's stabilizing from 360 onwards. So it's a kind of is it a turnaround? It is stabilizing setup and geared to growth. Is that the way to see?
Yeah, so I mean, there's obviously much more stability and clarity now than what we had last year and maybe even the previous year or during COVID and so on. But obviously there are challenges going forward because it's okay at the moment, but the real question is whether they'll be able to continue on this path, or whether there'll be some political or external factors that destabilize the situation again. So that's the uncertainty. But I mean, if things continue on this trajectory, then we think that there'll be possibly for the next few years we'll have fairly stable interest rates, exchange rates, and so on, which will help to support the recovery.
Sure. Just going to the last part of our conversation, I just want to drill down on some of these challenges you mentioned about, not in terms of the political environment, but from a global sphere. The kind of demand is slowing down, and some of the regions, particularly US and Eurozone, may kind of record low growth or in fact go into recession. I mean, UK and those places. Given that we have to get a lot of things right for our own turnaround, how much of an impact do you think the global scenario will have on us?
Right. So I think traditionally Sri Lanka is somewhat uncorrelated with the rest of the world, so we haven't had a huge impact when there have been during previous global recessions. So I mean, the last one was the great financial crisis 2007 to 9. So I mean, at that time we had our own challenges with the end of the war and so on. But if you take 2008, 9, 10, that period, there wasn't a major drop in our exports. So I think there was a slight dip in 2009, but that could also have been because that was like the height of the war, right at the end of the war, and maybe we were having difficulty getting orders and things like that. But apart from that year, there weren't any major dips in exports and things like that. So, and also even in terms of, remittances should be somewhat unaffected by the global conditions, because it's more to do with the conditions in the Middle East and oil prices and things like that. So, I don't think anyone is expecting oil prices to go down by a huge amount. So I think that will be also okay. And then the other source of dollars is tourism and so on. So difficult to say, because tourism only started picking up after 2009 with the end of the war, and since then we haven't had, until COVID, we didn't have any major global recessions or anything like that. But since we are in tourism and so on, probably we are not going to have a huge impact, especially since anyway we are starting off from a very low base compared to the last few years.
Right, fantastic. Thank you, Shehan, for sharing with us your insight into what's happening in Sri Lanka and the global impact and all. We look forward to seeing some of these policies get implemented and some of these conditions turn more favorably, because as we know, I mean, it's a case of if we don't get it right this time, it's as if there won't be a next time almost.
Sure.
So that's a key thing to look out for. With that, we wrap up for this week. I'd like to thank my guest, Shehan Cooray, Director, Head of Research at Acuity Stockbrokers. Until next time, have a good day. Bye.